Today's lesson is going to be Chapter 12, Problem 1B. You should be able to see Problem 12.1b on your screen now. And what we're going to be working with in this chapter is partnership accounting. And when we have a partner, of course, we are owned by two or more individuals. And when we start a partnership, sometimes the partners will bring assets from other businesses to the business, or they might just invest cash in the business. In this particular problem, we have two partners that are going to be forming a partnership, and they're going to start this partnership on April the 1st. Whitney Lang and Eli Capri form a partnership. Lang agrees to invest $18,000 cash and merchandise inventory that is valued at $50,000. When a partner invests in a partnership, if they're investing cash, the cash, of course, is worth the cash amount that they're investing. If they're investing other assets, such as merchandise inventory or equipment, the amounts have to be agreed upon by the partners before they are placed into the partnership accounts. So in other words, this merchandise inventory that Lang is agreeing to invest, the partners have agreed that it has a value of $50,000. So Lang is going to be one partner that's investing cash and merchandise. The other partner is Capri, and he's going to invest certain business assets at valuations that were agreed upon, and he's going to also transfer some business liabilities. And then he's going to contribute enough cash to bring his total capital to $120,000. Details regarding the book value of the business assets and liabilities and the agreed upon valuations follow. So for Capri, these are the assets and liabilities that he's going to be contributing. We only record on the partnership books the amounts that are agreed upon by all the partners when the partnership is formed. The partnership agreement is an important item when you're forming a partnership. What a partnership agreement does is it tells how net income will be divided among the partners. So in the partnership agreement for this company, they include the following provisions regarding the division of net income. There's going to be interest on 10% of the owner's original investments. There's going to be some salary allowances that are allowed to both partners, Lang and Capri, and then whatever's left over of the net income is going to be divided equally. In the first part of this problem, what they want you to do is journalize the entries to record the investments of the the partner Lang and the partner Capri in the partnership accounts. For a compound transaction, if an amount does not require an entry, you can leave it blank. So on April the 1st, we've got two journal entries that we're going to make. One to record the investment for each one of the partners. Since there were two partners in this problem, there'll be two journal entries. In your instructions, you'll remember that the business was formed on April the 1st, so the date of these transactions are going to be April 1st. Remember, there were two partners, Lang and Capri. And in the first part of the problem instructions, they tell you that Lang agrees to invest $18,000 in cash. Since Lang is investing $18,000 in cash, the partnership's cash account will be increasing. To increase an asset, you would debit. He also is investing merchandise inventory that was valued at $50,000. All the partners have to agree upon this valuation. Merchandise inventory, if you'll remember from Accounting 120, is an asset account. It too will be increasing here for the agreed upon amount, which was $50,000. The remaining part of this journal entry will credit the capital account of the partner that is making the investment. So make sure you read properly. This one was for Lang that we were talking about here. So this would be Lang Capital that we are crediting. We're going to credit the capital account for the total amount of the investment. $18,000 plus $50,000. The total amount of the investment was $68,000. So Lang has an investment in this partnership now of $68,000. On the next transaction, you can see it has multiple parts to it. This will be the transaction where the second partner, which is Capri, is investing all of these accounts. Now remember in your instructions, Capri is investing certain business assets at valuations that were agreed upon by the other partners. He's also transferring some liabilities. And a key to this is that he is contributing cash to bring his capital to $120,000. So I know that I'm going to increase my cash, but right now I don't know how much that cash is going to increase. I'm going to have to figure it. But what I do know is that he has contributed accounts receivable. So my accounts receivable will also be debited because accounts receivable is increasing. The agreed upon value of the accounts receivable was $43,400. So $43,400 would be debited to the accounts receivable account. You are also going to bring forward the allowance for doubtful accounts. The agreed upon balance was $3,500. So my accounts receivable would also have an allowance for doubtful accounts associated with it. That allowance for doubtful accounts will be a credit. We're not through with all of our debits yet, so I'm going to skip over that for just a minute and I'm going to come back to it. My merchandise inventory that was contributed by Capri has an agreed upon value of $28,900. I'm going to go ahead and list that next. He also has invested some equipment in the business. Now, something that you might want to know about plan assets when they're invested in a business. Again, the plan asset has to come in at the agreed upon amount by the partners. The agreed upon amount for the equipment is $63,400. So that's what we're going to debit to our books of the new partnership accounts. that $63,400 will serve as like the cost of the asset, and you'll use that to depreciate. We do not bring forward the depreciation account. We just bring forward the amount that was evaluated or was agreed upon value for the account. So the equipment would be debited for the agreed upon value, and the amount is $63,400. Also, you're going to bring forward your liabilities, because the agreed upon value has to be the balance of the liabilities. You can't, unfortunately, change how much you owe to your creditors. We're going to use $23,400 to credit to the accounts payable account. Now notice here they don't give us accounts payable. So what you have to do is start your credits in this transaction with the allowance for doubtful accounts. Remember that the allowance for doubtful accounts is a contra asset account, and it would have a credit balance. The agreed upon value of the allowance for doubtful accounts was $3,500. So that $3,500 is going to go in as a credit to my allowance for doubtful accounts. The next account that I would credit would be my accounts payable account. You see now that we have that to choose from in the list. In the real world, it doesn't matter about the order of the credits, but in this particular problem in Cengage, you have to choose what they give to you. So the best answer is accounts payable. The agreed upon value is $23,400, and so that's what we're going to record as the credit. Remember, accounts payable is a liability account, and therefore it increases on the credit side. And so when we bring that liability into this new partnership, it's going to have a credit balance now in the accounts payable for $23,400. We also have brought forward one more liability, which was called notes payable. The notes payable, notice, is the current portion of notes payable for $15,000 is the agreed upon amount. And that too would be credited because liabilities increase on the credit side, and we're increasing the liabilities for this new partnership. The last blank that we need to fill in here is for the amount of the capital that will be credited to Capri's capital. So make sure you choose the correct capital account. Remember, this was for Capri to our instructions. And also look at your instructions again. Notice here it says we want to bring his total capital to $120,000. So that means we're going to record this capital at $120,000. Now, what we didn't know was the amount of cash. This cash becomes a plug figure that we need to debit to make our debits and our credits balance in our journal. Your debits and credits always have to balance. So what I'm going to do is I'm going to add up all my credits. I had a credit to the allowance for doubtful accounts for $3,500. I'm going to add to it the accounts payable and the notes payable. And then I'm going to add the balance that is in the capital account. From this total, I'm going to subtract my accounts receivable balance of $43,400, $28,900, I'm subtracting, in other words, my debits that I do know that I have. And what's remaining is $26,200. That $26,200 is what Capri has invested in cash into this business. So these are the two journal entries that allow the partners to come into the business. In the next part of this problem, they want you to prepare a balance sheet. Notice the date on this balance sheet is as of the date that they first started their business. In the real world, we probably wouldn't have completed a balance sheet, but I think they just want you to see, or it's a review for you to know how to prepare a balance sheet. Technically, this balance sheet should be prepared at the end of the first year of the operations. Remember, the date that we are organizing this is April the 1st. So I don't really agree with the date here, but it is a balance sheet, and they do want to review you on how to prepare a balance sheet. You remember your balance sheet consists of assets, liabilities, and your owner's equity. Notice your owner's equity part has changed to partner's equity. This is because this is a partnership form of business, and instead of having one capital account, we'll have multiple capital accounts for the number of partners that are in the partnership. In this partnership, we only have two capital accounts, so we're going to be filling these in the partner's equity account. Also, this balance sheet is in what we call the classified report form. What classified means is that the assets will be broken down into current assets and property, plant, and equipment. What they failed to put on here, I think, is what that you covered in the last chapter. There would also be a section for your intangible assets on the balance sheet. But in this partnership, they don't mention any intangible assets. So we're going to start with our current assets. Our current assets are all of our assets that we can either convert to cash within 1 year or are already cash. So always on your balance sheet, your first asset account is going to be your cash account. Now your cash account will consist of the cash accounts that are the cash that was contributed by both of the partners. So what we're going to have to do is add what Lang contributed in cash, which was $18,000, plus what Capri contributed. The total cash that is in this partnership now is $4,200. Also, under your current assets, your next current asset that you would list most likely would be accounts receivable. So accounts receivable is going to go in here at the total amount of accounts receivable. Notice only Capri contributed accounts receivable, but it is the partnership's accounts receivable account now, and so the balance is $43,400. Right underneath the accounts receivable would go the contra asset account that belongs with the accounts receivable account. And this account will be your allowance for doubtful accounts. Notice it says less allowance for doubtful accounts because the contra asset will subtract from the accounts receivable to give you the net realizable value. The allowance for doubtful accounts comes from the $3,500 that was contributed to the accounts receivable by Capri, the partner Capri. So this is $3,500. And the difference is what we call net realizable value. So we're going to take the balance in the accounts receivable of $43,400. We're going to subtract $3,500 from that. And what that will leave us with is a net realizable value of accounts receivable. What net realizable value means is that's the amount that they're really expecting to collect out of all of the accounts receivable. This is a more realistic amount. And that net realizable value for accounts receivable is always reported on the balance sheet. The next type of asset that is a current asset will be your merchandise inventory. Notice that both partners contributed some merchandise inventory, so you're going to have to add the two amounts together to get the total value of the merchandise inventory. So $78,900 is the value of your merchandise inventory. Once you know all of your current assets, you'll combine the amounts together to get the total of the current assets. The next section of the balance sheet is for your property, plant, and equipment. Remember, we had equipment that came on the books at $63,400 that was contributed by Capri. Notice there's no place for the accumulated depreciation. When we are starting a business and the partners are investing in the business, they will bring forward the agreed upon value of the plant assets. There would be no accumulated depreciation at this point. At the end of the year, however, we would depreciate equipment using the method that they have deemed appropriate for this business. You'll remember from last chapter, they could have used the straight line method, they could have used the units of activity method, they could have used declining balance method. We don't know what that is right now because this is a balance sheet that's prepared on the first day of operations, not on at the end of the year. At the end of the year, there should be some depreciation that you would record in the accumulated depreciation account. The next step on this problem is just to add the total of the current assets and the plant assets together. So 163,000 plus 63,400 is going to give you the total amount of 226,400. The next section is your liability section. Your liability section in a classified balance sheet would be broken down into current liabilities and long-term liabilities. Notice in this problem, there were no long-term liabilities, but both liabilities were current. The first liability was accounts payable. the amount of accounts payable in your ledger will be $23,400. That ledger account would be copied to your balance sheet. And notes payable is also current in this situation. Notice they told you it was current up here in the problem. What current notes payable means is that you'll be able to pay that off within 1 year. And the amount of that note payable was $15,000. The next part of this balance sheet wants you to add up the total liabilities. So 23,400 plus 15,000 equals total liabilities of 38,400. The last section of the balance sheet is to prepare the partnership equity. Remember, there were two partners. One of the partners was Whitney Lang. Her capital balance was equal to what is in the ledger, and Lang capital was $68,000. The other partner's share capital, Capri's capital, would be for the amount that Capri invested, which was $120,000. The next step is to total up the partnership equity. The partnership equity is the total of the two investments. In this problem. It's not always like that. Remember, this was a beginning balance sheet that they're doing. If it had been at the end of the period, we would also have to consider partners' drawing accounts. But in this case, these were the investments. That's all we know right now. So we're going to add the two of these together. To get a total amount of $188,000. The partnership equity plus the total of the liabilities will equal the total liabilities and partnership equity. The two of these together have to balance back up to the total assets of $226,400. And this is how you would complete the balance sheet. In step 3, it's telling you that after adjustments at March 31st, 2000 Y2, the end of the first full year of operations, the revenues and expenses, or the revenues were $598,000 and the expenses were $480,000. Remember, from Accounting 120, you would have to do an income statement first, and on this income statement you would find net income. To find net income, we would take the total of the expenses from the total of the revenue. What's left over in this case is a net income of $118,000. So what we're going to be doing in these problems here is we're going to be closing out our revenue and expense accounts first. We're going to close out our drawing accounts in the second journal entry. So in the second journal entry, the drawing accounts have debit balances of $40,000 and $30,000. $40,000 for Lang and $30,000 for Capri. what they want you to do is journalize the entries to close. They're doing closing entries here, the revenue and expenses, and then they want you to close the drawing accounts at March 31st. So one of the first things that you could possibly do is you would need to know what you are closing out. In the first journal entry, we're going to close our revenues and expenses, and then we're going to close out our net income to our partner capital accounts. What you have to realize about net income and a partnership form of business is that the net income will need to be divided amongst the partners at the end of the period of time. We divide this net income based on the way that they share profits and losses. And they're going to have to tell you the way that they share profits and losses. And that information was given in this part of the problem where it talks about the partnership agreement. The partnership agreement is going to state how profits and losses are going to be divided. So before we can determine what the net income is that would be divided among the partners, we have to do some calculations. And so I could go ahead and start this journal entry, which I'm going to do, but to finish the first journal entry, I'm going to have to show you some Excel spreadsheet calculations. So I'm going to go away from the screen for just a moment. But before I do that, I want to go ahead and show you that your revenue would be closed out. The total revenue amount would be debited for the 598,000. When you debit revenue, you are zeroing it out, you are closing it out. Now, most of the time when we're recording revenue, when a partnership has earned revenue, you would credit the revenue account. But this is a type of closing entry, so we're reducing our revenue off of our books. So we're going to have to debit our revenue account. We would also have to credit our expense account to reduce them off of the books for an amount of $480,000. Now, the other part of this is we need to divide the net income between the partners according to the way they share profits and losses. I can't fill in the credit parts of this until I have determined the amount of net income that each partner would get. So the net income is $118,000. And an important part of this is the partnership agreement. Notice the partnership agreement says that we're going to divide the net income by first figuring out an interest of 10% on the original investments. So these original investments here, $68,000 for and $120,000 for Capri, are going to have to be multiplied by 10%. That's the first thing you're going to have to do. They also, according to the partnership agreement, are going to be given salary allowances of $36,000 for Lang and $22,000 for Capri. What I would like to say about that is that these salary allowances in the partnership agreement are just a way to divide net income. It does not mean that the partners actually got salaries of $36,000 and $22,000. It's just a way to distribute the net income. It's just what the partners have agreed upon when they form the business. The partnership agreement would come about when partners or have decided that they're going to go into business, they need to know how to distribute the net income among the partners in a fair way. So they agree to this before the operations have started, before there is any net income to split. And this is just a part of the agreement. All right, so I'm going to stop sharing for just a minute, and I'm going to go to my Excel spreadsheet and show you how to calculate the division of net income. There's a process to that, so hold tight. I'm going to share my screen with you for the Excel spreadsheet. All right, you should be able to see now the Excel spreadsheet that I prepared for this particular problem. You'll remember that the original investment for Lang was $68,000 and for Capri was $120,000. That's the first part of this problem that we found for the capital accounts. The instructions told us that the partnership agreement agreed that the partners would receive 10% on their original investments. So what you have to do is you have to multiply the original investment of each partner by 10%. So when we look at the original investment was $68,000. We would multiply that by 10% and you would get $6,800. We would also multiply the original investment by 10% for Capri. Since his investment was $120,000, we would multiply that by 10% to get $12,000. Then what we do is we take the annual salary allowances and just record those. The annual salary allowances were what was according to the partnership agreement. For Lang, it was $36,000, and for Capri, it was $22,000. I've made up a total column where I've added the two of these together to get a total salary allowance for the partnership at $58,000. The interest allowances we figured from cell B3, there was $6,800 for Lang, and it was $12,000 for Capri. The two of these added together again will give you the total of the interest allowances. The next step is to total up your allowances. For Lang, the total allowances would be $36,000 plus $6,800, which would give you $42,800. For Capri, the total amount would have been $22,000 plus $12,000 or $34,000. And then when you combine both of the total allowances together, the entire partnership total allowances now amounts to $76,800. Then I'm going to take the amount of net income that was given to us. The amount of net income was $118,000. I'm going to record it. I'm going to subtract from that the total allowances. The total allowances includes both of the partners' allowances. In other words, the total allowances comes from the entire partnership. $42,800 plus $34,000 will give you $76,800. The difference between your net income and your total allowances will leave you the difference that should be divided according to the way the partners share profits and losses. In the partnership agreement, it stated for this problem that the partnerships would divide profits and losses equally. So this remainder, this difference here of $41,000 would be divided in half to get the partners' differences of the net income, or the amount that is divided and given to the partners of the net income. So again, that difference is multiplied by half, or you could divide that by 2. It would also have given you $20,600 that would be shared by each partner because the net income was divided equally. The next thing to do is to figure out what each partner's share of the net income will be. To do that, we start by putting in the annual salary allowance, which was just copied from above. That was given for Lang. It was also given for Capri. The interest allowance we figured was 10% on the original investment. That was 10% of $68,000 for Lang, which gave them $6,800, and 10% of $120,000, which would give you $12,000 for Capri. The total allowances for Lang would be the salary allowance according to the partnership agreement and the interest allowance together. For Capri, we would do the same thing. We would add the salary allowance plus the interest allowance to get the total allowances for Capri. The remaining net income was divided at $20,600 for Lang, and because it was divided equally, Capri also got $26,500 or $20,600. I don't know where my brain went there. To find the net income, this is the important part about this entire spreadsheet, is to add up all the salary allowances, the interest allowances, and the income that was divided. The total amount of net income that would be given to Lang is $63,400. For Capri, it was the annual salary allowance plus the interest allowance plus the remaining net income that was divided for a total of $54,600. Now, when you're doing future problems, you might want to realize that I've added a note to this so you'll understand future problems. Note, it says that if the total allowances are less than the net income, which my total allowances were $76,800, they were less than my net income of $118,000. If the total allowances are less than the net income, the difference is divided by the way the partners share profits and losses. Remember that difference of $20,600 was divided between the partners equally. The amount would be added to the total allowances of the partners to get the net income that would be added to the partners' capital accounts when you close the revenue and expense accounts. So these two amounts here are the amounts that are so important when you are recording the net income that will be given to each one of the partners. In another scenario, what could have happened, or a what if to this to make sure you understand fully what we're talking about here is sometimes the allowances may be more than the net income. If that is true, the difference will be negative, but it will still be divided by the way the partners share profits and losses according to the partnership agreement. If the difference is negative, then instead of adding the remaining income, we would have deducted it to get the net income that would be divided by the partners. So I just want to make sure that you had this to add to your notes. And I would study over this Excel spreadsheet because it has important information about the way you share profits and losses. Now, getting back to Cengage, I'm going to take the amount of the net income that I'm going to give to Lang and credit it to his capital account. The amount for Lang was $63,400. For Capri, the capital account will be credited for $54,600. That is the net income and how it was shared. So I'm going to stop sharing this. I'm going to go back to Cengage. So bear with me just a second till I can get there. And you should be able to see Cengage again. So where we left off was we had to divide the net income between partners. Net income will add to the partner's capital accounts. The first partner is Whitney Lang's capital, and the amount that we divided of net income amounted to $63,400. Again, the calculations for this are on your spreadsheet that I showed you earlier. The capital account for Capri would be $54,600. When we divide net income between the partners, the net income will add to the partner's capital account. You should have learned this on Accounting 120. Net income adds to capital. That's why we're crediting each one of these capital accounts. We're adding to the capital account. So to review, close your revenues, which the amounts were given to you, by debiting revenue to zero it out. The expenses, each one individually, would be credited for a total amount of $480,000. Your capital is going to be increased by the net income that would add to the capital accounts. In the second part of this journal entry, they want you to close the drawing accounts. There will be a drawing account for each partner. And in the instructions to the problems, they should have told you somewhere that the amount of the drawing, and it was right here in part 3. The drawing accounts have debit balances of $40,000. To close drawing, which normally has a debit balance, we would have to credit that account. The drawing account represents what the partner actually took out of the business. So it's going to also reduce the partner's capital account. When we reduce the partner's capital account for Lang first, we would debit the capital account for Lang for $40,000. We could credit the drawing account for Lang for $40,000 a year. We would debit the capital account for Capri for $3,000, which they withdrew. And we would credit the drawing account for Capri for $30,000 to reduce it to zero. Now, technically, we could have made two journal entries out of this. Cengage may not be happy with the order that I put these in. So if it gives me a X mark on here, then what they wanted me to do is put my two debits first and then my credits. So I'm going to click check my work. Now, they didn't appreciate what I did here. But class, in the real world, this could have been done this way. It's just Cengage doesn't know the difference. So let me fix this and put both of my debits first. So I'm just simply going to move that 30,000 to my debit portion, and I'm going to move the account and call it the capital account to the debit side. Then I'm going to take out what I originally had there, and I'm going to record the Lang drawing here. If it'll allow me to do it. I know it's incorrect, but I need to put it in there. The drawing would be credited for Lang's amount that he took out, which was $40,000. And then your transaction will be correct. I know it's saying incorrect here, but it would have been just fine. So let me repeat this so it'll be clear to you, because I know you can't see it on your screen right now. You would debit Lang Capital for $40,000. You would debit Capri Capital for $30,000. You would credit Lang Drawing for $40,000, and you would credit Capri Drawing for $30,000. And so that this problem. I will see you again for another problem. I'm going to stop sharing this, and we'll see you again the next time.